When I talk about financial defense with potential clients, I usually start by asking them this question. If you have a stock portfolio that loses 50% of its value, do you know what percentage you have to regain in order to break even? Some people know the correct answer is 100%, but a lot of them will automatically say 50% because that seems most obvious. Somehow they forget that if you start with $1 in the stock market and you lose 50 cents, you have to double the remaining 50 cents to get back to $1. That's doubling represents 100% gain. If you earn only a 50% gain, then at 50% only gets you back to 75 cents, and you're still a bit short. That's how the math really works. Now, in the late 1990s, that question might have seemed irrelevant because people probably would have said, a 50% market drop? How likely is that? Well, it may not have seemed very likely during the best long-term secular bull cycle our country has ever seen, but that all changed at the turn of the century. Since 2000, investors have actually gone through this scenario not once, but twice. The first started in 2000 when the market bottomed out in 2003 and recovered in 2007, back to the previous peak. The second began in 2007 and bottomed out in 2009, fully recovering by 2014. Notice that in both these cases, the drop took 7 years to get back near the previous peak. This presents two important questions. The first is it possible that this happens again? And the second, how will this affect you personally if your investments are underwater for 7 years? Regarding the first question, think about this. Do you believe, generally speaking, that history tends to repeat itself more often than not? Most likely you answer that question with a yes. And the fact is that we have nearly 200 years of history that says that there is a very high probability that there will be another significant market drop around the corner. Regarding the second question, how will it affect you personally? Only you can answer that. It might seem a little surprising that even investors whose portfolios were hurt by those enormous drops need to be reminded about the importance of financial defense and protecting their money. But more often than not, it's true. Human nature is partly to blame, but the biggest reason is simply that defense isn't emphasized nearly enough in the financial industry. Most advisors don't talk about it much at all, and you certainly never hear it mentioned by a broker or in the financial media. Unfortunately, that's because a lot of people in our industry are salesmen first and advisors and educators second. And if you're a salesman, it's a lot easier to focus on the sexier, well-known strategies designed for capital gains and the lesser-known conservative tools designed to protect your downside and provide income. For a salesman, the stock market is the path of least resistance because it's the flashiest product and the one most people are already familiar with. Oh, and by the way, which kind of investment tools and strategies do you think are designed to pay the highest fees and commissions? You got it. Oftentimes the riskier ones. So there are again, salesman first, financial educator second. The fact is most advisors end up being what I call Wall Street cheerleaders. They repeat the same cheer over and over and over. Hang in there. The market always comes back. The market outperforms everything else over the long run. And the ever popular, it's not about timing the market. It's about time in the market. Sound familiar? Let's face it. When is Wall Street likely to sell more of its products? When people are pessimistic about the market or optimistic about the markets? The answer is obvious. That's why most Wall Street advisors end up being these Wall Street cheerleaders. It's easier and usually more profitable for them and for their companies to keep you fully invested in the stock market at all times. But unfortunately, it can also expose their clients to hard-earned savings to a lot of unreasonable and unnecessary risk. That's especially unfortunate for clients at or nearing retirement, who, as a rule, don't usually have the means or the time to rebuild their savings by 100% when the market takes a nosedive. Remember, it took nearly 7 years each of the last 2 times the market took a nosedive. just to recover. And don't forget that we have nearly 200 years of history that says this is a very, very high likelihood that there will be another significant drop around the corner. In my next video, I'll talk about market history and how I can say so confidently that there's probably another major drop on the way. So don't miss it. In the meantime, think about Warren Buffett's 2 rules to investing, which is something I often share with clients because it summarizes the importance of financial defense even better than I can. Rule number 1, never lose money. Rule number 2, never forget rule number 1. After all, who's going to argue with Warren Buffett? Certainly not me.